Hello and welcome to Your Money, Your Call. I'm Margaret Lomas, and joining me on the program tonight is Ian Rodriguez from Bishop Collins and Ben Kingsley from Empower Wealth. We've got a lot to get through tonight and hopefully you'll join us. And if you have a question for us, call us now on 1300 30 34 35, or you can email us on property@skynews.com.au. Now, we've got some news for you later on, but for now, let's get straight into it and we'll have a chat to Ian and Ben. Thank you for joining us tonight, both of you.
Good to be here.
Now, before we go, I know you're itching to give us a little announcement, so let's get it out of the way at the top of the show. What's going on Wednesday night?
Well, on Wednesday night, we've got a seminar for property investors. There's four of us presenting it.
So that's who? You and Lisa?
Yep.
Rich?
And John Lindman. So we'll have quite an experienced panel there talking about all their areas of expertise. So it's good to get in the room people who are expert on property, people who are expert on finance, and of course I'll be talking about taxation. So, you know, look, we'll keep people awake, I'm sure, so it should be exciting.
How do we get tickets?
Good question, but I'm sure we'll have later on the show be able to show people how to do that. But there is a email address, website to grab all those tickets.
We'll get that a little bit later on in the show, but it's like only $19, I think, or $29 a couple. So, and it's at, I think, the Sydney Masonic Hall.
It is, yes. So looking forward to it. It should be a good night, and of course it'll be a size where people can actually take the time to come and have a chat to us afterwards as well. So
fabulous.
Yeah.
Ben, welcome to the program.
Thanks, Margaret.
Now, look, I've been having a little look at the news today, and dwelling values across Australia's capital cities have been rising in April, but it's been a little quieter, and I guess in a little bit of a surprise, although I'm happy, Adelaide has done very well during April at 2.2%, which is the highest across all states.
Yeah, look, it's a flow-on effect. We've seen Melbourne, Sydney and Brisbane do very well indeed, Margaret. And I think what we've also seen in the April slowdown, we can't obviously discount the holiday season. We had the school holidays coming into play, and then we also had Easter following that for Melbourne. For whatever reason, Victorians had an early school holidays, then we went into Easter, and then we had the Anzac Day break. So from that point of view, I think there was a slowdown and a general movement in the marketplace, less stock on market, less auctions. So the commentary was that the marketplace is slowing down in those particular areas, but we're starting to see, and from a marketing point of view too, with a lot of auctions happening in the Victorian and Sydney marketplaces, usually you want a 4 to 6 week marketing campaign. So what we're actually now seeing is a bit of a lull in terms of volumes of sales happening in that area, but they'll increase at the end of the month. So we're probably going to see a couple of very, very big end weekends in May for that particular marketplace. But Adelaide's done well.
Look, just having a look at the figures, I've got them here. We saw 2.3% across the board, 3.5% for the first quarter, but Melbourne was down 0.5% in April, Canberra down 1.1% in April, 0.2% in Perth up, Hobart 2.1% up, and Adelaide the same, 2.1% up. But across the past 3 months, we've seen Darwin with the greatest rise, and Sydney after Darwin. That surprises me with Darwin because it got so hot for so long, and I really thought that we'd see much more flat prices than that.
I don't read too much into the quarterlies. I'm looking for a more trend. I mean, you can get a rise or a bigger number out of a small sample base. So I think from that point of view, it's one of the things that I always start to say is show the trend is your friend. So, you know, if we're seeing similar types of things, when you go down to the suburb level on a quarterly basis, you can see fluctuations of 10 or 15%, and that could just be the stock of the moment on the market that's finding that median. So the trends are good. Look, obviously Darwin's being one of those marketplaces that still has very, very low vacancy rates. The major gas projects coming to an end. So I think, you know, from Darwin should be pleased with that number, as I think you were saying. But, you know, I think same with South Australia and Adelaide, in terms of we're seeing a transition away from heavy manufacturing down into, you know, a diversified economy. The trip of the Royals coming into Adelaide was also a nice move for them, and put them on the
They all went and saw Elizabeth, which is good news for those with property holdings in Elizabeth. Now, Ian, interest rate movements tomorrow, possibly? What do you think?
Oh, I think there'll be nothing exciting. I'm sort of, all the reading and the information I seem to get seems to say it won't be very exciting for a little while, and really a bit of a 0.25% move is a bit unexciting anyway, isn't it? Like really.
Yes. Well, I don't know. It depends on how geared you are, I guess.
That's
Something
right.
a 0.25% could be heaps.
If a 0.25% is going to cost you money and cause you a problem, you're probably overgeared, would be my tip. So
I agree. That's very true.
I think, look, in the long run with interest rates, Ben and I were having a chat about this before, and my very simplistic view for people investing is that, if you can't afford another couple of percent, we've talked about this before, on top of what you've got, if that's going to cause you financial hardship, you're probably overgeared.
Probably overgeared, which you shouldn't be. Look, let's go to the emails, and Alicia has written to see if she can do anything about some penalty interest that she's recently paid. She writes, I have a question about penalty fees for late settlement, which I had to pay last year. I've purchased a block of 4 units on individual titles, financed by different lenders. 2 of the units were settled in time, but the other 2, due to unprofessional handling by the broker, settled late. Are the penalty fees I paid to the seller tax deductible? That's an interesting one.
It is.
They're unusual to get penalty fees, so are they a tax deduction?
Well, I've got to. When I first had a think about the question there, it was sort of, well, what are these penalty fees? So, in New South Wales, you get your normal 42 days to settle. If you don't settle on time, then you're up for interest at a punitive rate. So that's why I think people refer to it as a penalty. It's a very punitive rate. I think the only rates that are worse are probably the tax office and the Office of State Revenue, who offer, not very cheap rates of interest. So if you can get it from your bank, it is better. So again, in this situation for Alicia, it's sort of a matter of, if it is just interest, if that's what she's copped, then the interest is much like had you paid the deposit and the money on time and settled on time, you would have paid interest to the bank, not to the vendor. So it's just interest as far as I can see, and not treated any differently. It's just that the rate's different and who you're paying it to is different. Now, sometimes when you're late, you also get caught for some legal fees too, because they have rights to sting you for different other charges and costs. So usually not a great deal of money, but there might be legal fees in there. So I think Alicia needs to work out what she's actually had to pay. Was it interest? Was it legal fees? Okay,
so the interest, by all accounts, probably should be deductible then, but the legal fees, will they become a capital cost?
Yeah, so the legal fees
deducted at the end of capital gains tax.
Yeah, so the legal fees when you purchase are almost always capital on the purchase price. There are some legal fees that may be part of your borrowing costs, and then you get a 5-year write-off. That's a different story, but the legal fees we're talking about in this case are just likely to be capital. So again, it makes it as confusing as all hell, but these are things that I wouldn't expect Alicia or investors to work out. You're best off giving it to your accountant, who will check their situation. So.
Absolutely. And Ben, of course, just quickly, there's a couple of things that a buyer of any kind can do to make sure that it does settle on time, and that's really to be all over it yourself. You do hand it over to your legal people, but you still need to be aware of your critical dates and make sure that you're in there well ahead and guiding those professionals toward ensuring that you settle.
Definitely, Margaret. I mean, one of the things is there's a lot of moving parts to a property transaction. There's lenders involved, there's solicitors, there's vendor solicitors, there's your solicitor, there's a transfer of title that's taking place. So I agree, we would want to see a lot of information being passed on to the consumer, especially from a broker's point of view. I mean, I would say to Alicia, if your broker's done the wrong thing also, you can potentially make a claim against their professional services or lack thereof to be able to do that. So one of the things for me is if you've been financially put out, that's the first sort of inquiries that I'd be making. But certainly, being abreast of those milestone events, the valuation, the unconditional approval, when do we need to sign and execute our line docs, when do they need to be back by, to make sure we've got ample time. And the final thing, that inspection on the property before you decide to take ownership.
Before you take ownership. Well, as we do each week, we'll be sending a prize for the question of the week. If the panel chooses your question, you can look forward to receiving a copy of one of my books. Now, this week's it's How to Achieve Property Success, which is a complete guide to everything you need to know about property investing. So why not call or email now and see if you can be the lucky chosen viewer. The phone number is 1300 30 34 35 and the email address is property@skynews.com.au. Don't go away, we're off for a break, but not for long, and we still have plenty left to do this evening. We'll be right back. It's certainly great to have your company on this Monday evening, and it's my pleasure to be joined by Ian Rodriguez from Bishop Collins and Ben Kingsley from Empower Wealth. Now, I'm sure you have a burning question about property, so if you do, call us right now on 1300 30 34 35, or of course you can email it to me at property@skynews.com.au. Look, before we go to more questions, I'd like to talk about interest rates again, because we've really only been talking about what's going to happen tomorrow, but we certainly get some good indications about long-term views on interest rates by looking at what the government's doing, by looking at what the banks are doing. Now, what are we thinking in terms of long-term, Ben?
Look, Margaret, I think we're seeing the bottom of the variable cash rate at the moment, and that's got a lot to do with we're seeing retail sale figures increasing higher, where it's seeing lending rates at 5-year highs. Now, predominantly there's a lot of investment activity in that, so there's a little bit of heat in the property market, as we've obviously well documented. And so we're starting to see those sorts of signs that the RBA is saying to us right now that, you know, longer term, medium term, we're probably seeing rates sitting at the bottom and then moving higher. So I've got a view that we'll probably see rates moving around 25 basis points in that sort of September, October, and that's going to be subject to an inflation number that we see coming out in the middle of the year. That number would maybe be outside of the Reserve Bank's comfort zone of that 2 to 3%. The other alternative argument is that with the sentiment around the budget, you know, this is going to be a challenging budget for Joe Hockey, and with such a challenging budget, what we're going to see if that sentiment shifts. So if people stop spending and they start going internally and start looking at their household finances thinking they're going to have higher taxes or less benefits, then we might see the economy slow a little bit, which means that the RBA won't have to move on rates. If anything, you know, rates will stay flat for the remainder of the year.
That being the case then, Ian, what do you think about fixed rates? A lot of people seem to rush out and fix their rate when I think it's the worst time to do so, and don't fix their rate when I think it might be the best time to do so. What's going on with that?
Well, I think the key is that, you know, if you're trying to pick a winner here, you know, Star City's there for sort of picking what might turn up. I think, in all honesty, you should be fixing rates when it's about hedging and managing your interest rate cost. And that's really what it's about. If you're just trying to pick it to be the winner, it's very hard to do that. Some are going to win, some are going to lose, because people are voting either way. So, you know, if it really is a matter of managing your interest rate risk, then probably fixing. The long-term predictions on rates are saying they're relatively flat. Now, when I mean relatively, I mean there might be 1% or so in there, but in relative terms, that's not a big number. And back to the comment we made earlier, which was if 1% makes that big a difference to you, you really need to consider your gearing level.
Absolutely.
It's nice to win every time on these things, but it's not the way it works.
No, it's crystal ball gazing, that's for sure.
Now, look, there's been a little bit of heat again about underquoting. You know, we normally see everyone complaining about it in Melbourne. Now we're complaining about it in Sydney. And we're seeing that although there's really laws against underquoting, there's a lot of people who believe that it's still happening. And, of course, the big problem with this underquoting, and it occurs whenever there's an auction, or not every time, but it occurs around auctions. The biggest problem, of course, with underquoting is that, particularly for investors who might go out and pay for their pest and building reports beforehand, thinking that they're about to buy or maybe about to buy a property in their price range, and if the underquoting just throws it completely out, then they've wasted $500. And that $500 isn't a tax deduction, is it?
It's just going to be lost in the scheme. I think it really is a nuisance thing, and I think it was interesting that the article was saying people haven't had a lot of complaints being lodged with fair trading around this. I mean, I think it is an annoyance. I think I'd be quite annoyed when an agent's told you a figure and it's so far out, and you've gone to all the troubles and costs. But, you know, to be honest, it's just an annoyance. It's not a major cost. In fact, the bigger concerns that I sort of have around the property transactions are back to our question with Elise was saying about being late settling. I mean, a big trap for New South Wales viewers when you buy interstate is how different the laws work in there. If you have that same problem in Queensland, you've got a much bigger problem.
Oh, you have, because time is of the essence in Queensland, and that means that if you miss your settlement date, technically the vendor can cancel your contract and keep your deposit. Yeah,
which I think, you know, when you look at that as a problem, as compared to I spent $500 on pest and building and the agent wasted my time, I'd like to think agents don't do it deliberately. it's hard for the agents to pick a price because, you know, they're being guided by that, and then, you know, people are coming along and getting excited or whatever they're doing and paying more. It's hard to pin it all on the agent, I think, you know, as long as they're acting in good faith. Yeah.
Look, I think, Ben, it is fair enough to say that most agents don't do it deliberately, but there's definitely agents who do it deliberately. You know,
spoken, quote it low and watch it go.
Yeah.
So, I mean, let's give the viewers some tips here. The tips have got to be do some research. Now, if you think that that property value seems lower than what they actually think the marketplace is determining, which is obviously that reason why agents do that, is they obviously want to get a bit of interest in the property. It looks great for the way in which they're handling the vendor. So the tip from my point of view is if you put an offer in to the real estate agent, which is a firm offer, they must change that quoting range. By law, they have to do that. Licensed real estate agents need to do that. So if you're on a property that they're quoting $550,000 or offers above, what you need to do is, if you think it's worth $580,000, put your offer in. You've done your research, you've done your homework. Do that before you go off and get the building and pest. Try and make it subject to. Obviously, if you're in a campaign, it's the lead-up hours before the auction where you're out of the cooling-off period. But if you're 2 weeks or 3 weeks before the auction's about to start, I would say to a client, go out there and put a firm offer in, because that will force the hand of the real estate agent to adjust the valuation in terms of what the quoting range might be. So there's a little tip for your viewers, Margaret.
and it sounds like a fabulous tip too. Well, time is flying and we must take a break, but while we're gone, you can make those calls to us with your question and you'll be first up when we come back. The number is 1300 30 34 35 and the email address is property@skynews.com.au. Stay with us and we'll see you in a minute or so. It's great to see that you've stayed with us, and I'm pleased to be joined tonight by Ian Rodriguez from Bishop Collins and Ben Kingsley from Empower Wealth in the studio and doing a great job answering our emails so far. But if you'd like to ask a question live, just call us now on 1300 30 34 35 to join the queue, or you can email us on property@skynews.com.au. And Bob from Sydney, how are you going, Bob?
Hi, very well, thanks.
What can we do for you?
I've got a general question on borrowing for investment properties. Do these investors who have a lot of properties, do they have the same lender?
That's a very good question, and you know there's arguments for and against, and I know, Ben, that I'm very much for having the same lender because I believe you build a good relationship. It can be easier to get increases. You can get small increases for deposits. There are a lot of people who believe that, you know, if you're at the mercy of one lender, then they've got you screwed or tied up nice and tightly. What's your view?
I think you should be led by the professional advisor who you're working with, because they're going to have the experience in the marketplace, Bob, that is going to guide you. So Margaret takes a strong view in one area. We take a view that usually the first 2, 3, maybe even 4 investment properties, which is a sum of around maybe 1 to 1.5 million with one lender, and then we might move on to a second lender in terms of the way in which we diversify. The reasons why you would do such a thing can come down potentially to servicing. So if you're chasing properties that have a higher capital gain aspect to them and less yield, then the shortfall you're going to have to cover with your income. Now, some lenders will look at that and service you harshly, whilst other lenders might be willing to lend you that money. So it's going to come down to your particular situation and how you're going to handle that and the information that the broker's got to advise you accordingly.
And certainly, Ian, I agree that if, you know, your lender isn't going to advance more funds to you, you don't just accept that. You can have a multi-lender strategy. But in your experience, what works best?
Well, I think it comes down to service and prices, you know, two different things here. But what you'll find is, we've found, is always that the appetite for certain things or lenders and where they're at with different things at different times can vary. So sometimes the answer from one is no because of their own particular profile or what they've got money tied up in, whereas other lenders are keen to get into that market. So
I find that, you know, having all of my borrowing with the one bank actually gives me that ability to even negotiate on my rates. So I frequently go back to them and try and screw a bit more off the rate and a bit more off the rate and a bit more off the rate.
which is the price side of the equation.
Yeah, and a lot of people don't realise that a bank is actually capable of making out of publicised decisions. They may have the publicised rate, then the publicised discount, and there's actually room to move a bit more even past that a lot of people
And if
don't
you're a
realise.
business lender, you know, investment loans might be, you know, in a smaller range, but business lending, the bank's got a lot of discretion as to how much they charge.
Yes.
I've often said to our banking, expert banking people, I said, I don't believe the bank actually puts enough difference between the price on good lends as compared to price on poor lends. The banks have made some appalling lends that had very competitive pricing on them.
Great.
And somehow there I feel like we're paying for it. So
Yeah, I think we are, indeed. Okay, let's go back to the phones again. And Sonny, you're also from Sydney. How can we help you tonight, Sonny?
I'm great, Margaret. Firstly, thanks a ton for bringing this program to us. It's been terrific. We have been following you last 2 years.
Thank you.
My question was around how big is big enough as far as property portfolio goes. Sort of last 6 years, we have developed a portfolio of 8 properties, all in that affordable category. And in today's market rate, actually they are all positively geared because they give us something in return. So the question was, based on your experience, what are the things to look out for, and how big should we continue to develop the portfolio? We are sort of in mid-45 now, around 45 years old now.
Okay. Look, that's also a great question, and I think one of the biggest issues that we have these days is, you know, people go and write books on buying hundreds of properties in 5 minutes, and it encourages people to think that you need those big portfolios, but you just don't, do you, Ian?
No, I mean, I think the whole idea, you've got to look at why you're investing anyway. So, I mean, I've seen some of those books where people have got hundreds of them and you sort of think it was a lot of effort. You could buy, you know, I don't know why you'd buy sort of $100,000, $300,000 properties. You could start to get into the next market up, which is, you know, $3 million properties or $30 million properties if you want.
Not that you would, because they'd make lousy investments.
Well, they may or may not. You got to look at it. But
I think the $30 million ones make pretty lousy investments.
Sometimes they do, I think. But yeah, but there is a, you know, certainly in terms of the size of an investment, there is a bigger market the smaller the investment, and more buyers for that. But in that space where you're talking 5, 10, 15, $20 million, then the buyer pool gets smaller, which has issues with resale, and you're going to sell it differently. It's not going to be sold to mum and dad investors. So it's horses for courses. Yeah.
What do you think, Ben?
Yeah, Sonny, it's an interesting question. The first question I would sort of ask you as your advisor would be how many is enough in terms of what type of income are you looking to supplement. These properties are about giving you passive income over the journey. And when you're getting that passive income over the journey, how many do you need to, one, firstly replace you working, and secondly, give you the type of quality of life that you're looking for in your retirement? Now, if you can answer those questions, you just simply work back and you then factor in the growth and the indexation on those properties and look at what cash flow you're going to have at that time. And that's the way in which I would advise many clients. There's no benefit in getting 20 or 30 properties if you don't need those 20 or 30 properties. I mean, I know that, you know, someone in our business has 22 properties and some of that requires a lot of work. You know, you're supplementing your job with managing your property managers. So the question should be for you is work out, Sonny, what income you want to have in retirement and then work back from that point. You may find that your 8 properties is enough.
And I think added to that, Sonny, you also have to consider your investment time horizon and your personal risk profile. In my experience, the average person who's looking for around about $100,000 to $120,000 a year in income needs 15 years and 10 properties. And of course around that depends on how much you pay for them. But that gives you an opportunity to diversify into a number of different markets. So buying them all in the one area would be a mistake. Diversify into different geographical markets. But if you've got less than 15 years, then you might need a few more than those 10. And of course, if your risk profile is that you don't like risk, then you should stay at around about the 8 mark. But if you're happy to embrace risk, then you can probably go a little bit higher. You definitely don't need dozens and dozens and dozens unless you are planning to build a major empire. But my experience also is that for a lot of us, once you start accumulating them, it gets a little addictive and you can't stop. That's certainly the only reason why we've bought 40 properties, because we just can't stop. But I think you're in a great position, and I think, you know, just start having a look at when it is you'd like to retire and whether those 8 are already enough to achieve what you'd like to achieve. Well, it's been great to have your company tonight, but it is time for another break. Remember that when we come back, your questions go into the running for a copy of my brand new book, How to Achieve Property Success. For your chance, call now on 1330 3435, or you can also email us on property@skynews.com.au. You're watching Your Money, Your Call. I'm Margaret Lomas, and with me on the panel tonight is Ian Rodriguez from Bishop Collins and Ben Kingsley from Empower Wealth. Now, I'm sure you have plenty of questions, so why not call us so that we can answer them for you? The number is 1330 3435, or you can email us on property@skynews.com.au. Jeff, well, the Sydney people are calling in tonight. How are you going, Jeff?
Well, thank you.
What can we do for you?
Well, I'm a self-funded retiree at this present time.
Yes.
But I have no property in my portfolio, but I am considering downsizing my current property, and I'm looking at some of the offers of leaseback from some of the exhibition homes that are currently available, where they're offering between 7 and 8.5% return. And I'm wondering what the panel's opinion would be on what are the traps to look out for in this. And secondly, would you recommend that I be using some of the purchase price by borrowing money in order to make the interest tax deductible?
Okay, self-funded retiree. I guess there's a whole lot of stuff around even self-managed super funds here and everything to consider, Ian.
Oh, the answer for Jeff is it depends. There's so many things to consider, Jeff, but depending on your situation, you know, you're talking about getting interest deductions. Well, are you paying tax anyway? I mean, a self-funded retiree may have their super fund and super money's not being taxed anymore if you're over 60. May have very little income in their own name, and there's this whole thinking that's got to change in your head when you get to, I'm not paying any more tax.
Well, certainly if you're not paying tax, there's no tax
deductions don't really
available on the property. So if you're going to borrow, you're not going to be able to offset any.
So it becomes a very pure decision then. You're gearing for the pure purpose of gearing to buy more asset. Yeah. There's no tax benefit attached to that.
And I guess under those circumstances, Ian, then you'd probably want to keep your gearing lower and low enough so that the ultimate result at least is that the property covers its own costs, including its interest, and leave a margin in there for interest rate rises. Yep. And you would be investing under those circumstances really purely hoping that the asset grows in value, so down the track you can realise that.
I think Jeff's main thing that just concerned me a little was with those exhibition homes, it's common practice that they may pay an above-market rent. They're disposing of the exhibition home. My question is, well, what's the true rent when this thing comes off the honeymoon deal?
Yes, that's a great.
Yeah, Jeff, thanks for the call. Display homes, exhibition homes, they do offer that higher yielding aspect to try and attract them into the attract you into the conversation. Ian's absolutely right in the sense that how is it going to stack up after the 3 years that it's had hundreds of thousands of people walk through the front door and trounce on it? So, you know, a good warning signal for these types of investments are a lot of banks don't like them. Now, when banks don't like them, they call it specialist lending. Now, they say it's specialist lending because there are risks associated with these leaseback types of things. So there's got to be more research done on the area and on the display home itself, because from my point of view, it's attractive to get you in, but you know, this is potentially a medium-term investment for you. We would like to see some growth in that asset, not just the income. So they're the things I'll be looking at considering.
I'm only going to give you 20 seconds with your extra point.
Yeah, I think, Jeff, the other thing about that whole thinking process when you're no longer paying tax is people think about tax deductions and all the tax write-offs that you're normally looking for when it comes to property. But when you're not paying tax,
There are
yeah, they're not relevant to you anymore. So,
Absolutely. Look, Jeff, I'd like to see you get a great deal of advice around this, because my biggest concern is that your decision to buy property is property focused and driven by the offer. And we shouldn't be driven to buy property because a particular property looks good. What if it's in a dud area? What if it's not in a hot spot? What if the area that this display home is in has absolutely no growth drivers about it, and you don't have much chance of it growing in value, because at your stage in life the ultimate aim for you is to make a capital gain out of the property. Obviously you want it to make rent as well, but if you're considering gearing it at all, then you're not going to have much of a cash flow on the property. The very first thing we should be doing when we become property investors is learning how to identify, first of all, the area that is the very best area to buy at that moment in time. And after we've identified the area, we then move on to the property choice. And if there happens to be something available there that might have a good offer at the time, then that's icing on the cake. But a good offer on a property is actually a bad offer if the area doesn't stack up in behind that asset. And I'd be concerned about you buying property until you became a lot more educated about how to do it well and how not to get yourself into trouble, and until you speak to an accountant or a qualified property investment advisor about the best thing that for you in terms of whether you gear or whether you use cash, or whether it's even an appropriate investment for you at this time in your life. Well, renovation costs on a property may be tax deductible, and this week Soretan has written to ask, I have a question about renovation costs. I just bought a property that needs to be renovated before tenanted. What steps do I need to take so that I can claim my reno costs at the end of this financial year? It's a great question, isn't it, Ian? Because a lot of people don't realise that the property needs to be income producing in order to claim a deduction.
Yeah,
so what can Soretan do?
Well, we only got bad news, I think, really. It's
I think we do.
Yeah, but I think people need to understand the rules, which is the important thing. So just because it's a repair, it doesn't mean it's a deduction. These initial repairs, where the property is inherently needing work, before the property's earning income and all that, are capital and form part of the cost base. So there are no steps to take. Look, there are construction allowances, there's still depreciation, so you can't, whilst you can't claim an outright deduction, there may well be construction write-off or depreciation to claim. Keep good records, give those to your accountant, is probably what you do need to do. If they're more significant, you'd of course use a quantity surveyor, which you're entitled to do to calculate what those costs were or are. Often it's the case, if it's a major renovation, you've paid someone, you don't know the breakdown of how much a sink was or a fire extinguisher and all those things, and a quantity surveyor does that for, you know, a very small amount of money, relatively speaking, and of course their costs are tax deductible too. So sounds like a plug for them, doesn't it?
It does, doesn't it? Well, look, just to clarify for you, Soretan, any items that you do get done, any renovations that you get done, you may have a claim for the loss of value, which will result in a little bit of a deduction. But what you spend on a lot of those things are your initial repairs, and it just adds to your cost base at the end of the time that you've invested, and then essentially reduces a little bit your potential capital gains tax. No help if you never sell the property, or if you sell when you're in a no tax paying time, such as retirement. Sometimes it's better to get the property rented and somehow try to work those renovations in around your tenants. I always suggest that if you can at all, give your tenants a bit of a discounted rent in return for them allowing you to come in and do bits over time, because at least if it's being rented, then some of those things will have a better tax deduction on them because they're being carried out as repairs while the property is income producing. Well, thank you for the great questions, but we do have to halt for a quick break. When we return, you'll have another chance to ask your question and possibly even win the book of the week simply by calling us on 1300 30 34 35 or emailing us on property@skynews.com.au. Welcome back. I'm glad you stayed with us. Joining me tonight on the show is Ian Rodriguez from Bishop Collins and Ben Kingsley from Empower Wealth. Now, if you have a question too, call us now on 1300 30 34 35 or email us on property@skynews.com.au. Mary, welcome from South Australia. How are you doing?
Very well, thank you. Yes, I've tried to get on many times over the years, but I do enjoy your program.
Fabulous. And you're on now, Mary, so what can we do for you?
Well, I'm wondering, when you're buying a property in Queensland, for example, what is a reasonable amount to expect to pay a property conveyancer?
This one's difficult, Ben, because it does differ from state to state.
It does.
And I guess in some of those bigger states where there's a lot of competition, you can get some really low rates, but still some really wide variances in what you pay. So what can you tell Mary?
And Mary, the profession is actually getting better. Like you'll hear a lot of people talk about solicitors and conveyancers. They're licensing conveyancers now. So my view is this is such an important asset that I wouldn't be chasing the cheapest conveyancer. You pay what you get for. So we have a rough rule of thumb. If your fees are anywhere between, say, $800 to $1,200, and make sure you ask them when you're actually dealing with them, are there any other fees that I might be charged? Conveyancers are getting very good at also putting title insurance opportunities in front of you and any other type of opportunity that they see that is in your best interest, but they need to explain to you in terms of what you're getting for your money. So my view around that $800 to $1,200 is where I'd be looking, and I'd be, sort of investigating maybe 2 or 3 and just talking to them about how they go about the process.
Look, Mary, I just want to give you a little tip as well. It's very, very important for you to know that when you're investing outside of your own state, everything's different, and everything is different in every state of Australia. So, for example, in Western Australia, nobody uses solicitors for conveyancing, but everybody uses settlement agents, and settlement agents are actually fairly cheap. And so that $800 to $1,200 price range may not necessarily apply if you're buying in Western Australia. In Queensland, people use lawyers because conveyancers aren't allowed to actually operate in Queensland. You must use a legal firm, or at least a legal firm for the legal parts of the contract. In New South Wales and Victoria, you can use a conveyancer or a lawyer, whichever one you like, although in Victoria, Ben, I understand that again the legal component is usually done by a lawyer, but the conveyancer often can outsource that.
Actually, Margaret, no, there has been some changes.
Some changes to that
and
now?
I think the same is in Queensland as well. So we're buying property in Queensland for our clients at the moment, and we're using a conveyancer.
Using a conveyancer,
Yes.
so that's
so that has been some
needed.
change.
But the point is, it's different in every state, and it's really important that you understand that the way you buy property is different in every state. And we have different rules around how long you get to settle and what the rules are if you don't settle on time, whether it's penalty, whether you lose the property. And I think the most important thing for you to do is to be able to work out the state that you're buying in and have a good long chat with a conveyancer or a lawyer, first of all, to find out exactly what you're getting and what your responsibilities are so that you don't make any mistakes or get caught. In another question for our tax expert, Gordon asks, I refinanced loans on 4 rental properties to add more debt, as I needed to come up with money for my separation settlement with my ex-partner. I'm wondering about my position on claiming this extra interest as a deduction. This one's really tricky, and I guess it just depends on how he acquired those properties, whether he acquired them from his partner or not, I guess.
Oh, look, it raises all sorts of questions here. So, Gordon, if he's got these properties, if they're in joint names, like, forget that this is a marital property settlement. If you're just bought properties with a business partner and you're buying them out, you remember interest deductions are use of funds. So if the funds were borrowed to use to buy out the other share of the asset, then of course they're deductible for these investment properties, of course. Not the family home or something like that, but if investment properties, that's what he's asked about. If these properties are already in Gordon's name, and then this is just to raise money to pay some equity to his former spouse on the settlement, it's a whole different story again. Now, it can get more complicated from there, and depending on business structures and asset structures in companies or trusts, there may be a chance to construct the borrowing in a way where they are tax deductible. There may be. You really need to talk to your accountant. But in the ordinary course, if it's just simply, I've got these properties in my name and I'm borrowing to give some equity to my former spouse.
Or some money just to say, well, okay, I recognise you've been with me all this time. Take a bit of money, I'm keeping the properties, but if they're always in your name, then you're really paying the spouse. It's not a deduction because the use of the funds wasn't for buying property. I guess, Ian, that can be one of the not often thought through complications when you have couples who are married, one party who earns a higher income buys the properties fully in their name, and I guess if you don't think ahead to, you don't do that because you imagine you're going to stay married, but that can that can be a complication because when you do that, you buy the properties in the higher income earner's name to gain a tax benefit. But in reality, you both own them because you're married, and down the track, you've got to get rid of that other person and pay them out on their share. From the tax officer's point of view, you're not really paying them out because their name was never on the title. That's
right. It's use of the funds is always the rule. So, and often, look, when people are trying to reach a family law settlement, it's an emotional time. There's other complications. People aren't thinking taxation, and often they've reached a settlement and then they ask the accountant to run an eye over it, and they're sort of saying, "Oh, hang on, there's some issues here." And if the parties have reached a difficult settlement, it's hard to go back and renegotiate it. So I guess now, worst case scenario, for Gordon is that if it is non-deductible debt, then of course he should be directing that repayments off that debt first. To clear it first. So.
Yes. So that would be just like your own home loan debt. And I guess the moral of the story is that if you are working out a settlement with a former spouse, you should check with your accountant before you actually agree to a settlement.
Absolutely.
Make sure you've got it right first. Keep those great questions coming as we still have a little bit of time left to answer them. For now, though, we're off for our last break and we will return very soon. In the meantime, call us now on 1300 30 34 35, or you can also email us on property@skynews.com.au. Well, time has flown and we're almost done, but we do have a tiny bit of time left to answer a question. And joining me on the panel to do that this evening is Ian Rodriguez from Bishop Collins and Ben Kingsley from Empower Wealth. Let's take a look at that last question. And it comes from, from Bruno, who says, I'm a first home buyer and looking into entering the property market. I live in Melbourne CBD and I was looking at one-bedroom apartments around the CBD, Carlton and Brunswick, which are averaging $350,000. I feel I'm already buying at the peak and I'm worried that I won't benefit from further capital growth in the long term. Alternatively, should I sacrifice distance from the CBD and buy something larger in the burbs? Of course, Ben, when people say, should I sacrifice the CBD to go somewhere dreadful like the burbs, it really does indicate that people still don't quite get the fact that it's the growth drivers that make an area grow, not its proximity to the centre of the city. And sometimes it's the centre of the city stuff that does grow, and sometimes it's the burbs that grow.
Absolutely. And I think from Bruno's question, the long term is really what I'm focusing on. So if we look at all cities around the world, convenience to CBD locations to get income is a really important aspect that's going to drive capital growth. So if you're taking a long-term view, areas like Carlton and Brunswick have been long-term performers. That's no guarantee of future growth. But in terms of looking at that and taking a long-term view, there might be something in it. The other areas that we always try and study from a scientific point of view is regentrification areas. So areas that are changing in regards to, their gentrification. So they're getting more younger people moving in, more professional people and pushing that income growth up there. That could be something to look at. In terms of going out to brand new greenfield estates, I would be hesitant in going out to those particular marketplaces straight up until I had some real confidence around the growth drivers that Margaret always talks about before I'd look at that. So if you're taking a long-term view, there's nothing wrong with city fringe, that was going to meet, remembering that you're a first-home buyer as well, so you're looking at some lifestyle elements as well as looking at some investment returns. But overall, it's going to come down to your research.
Absolutely. And Ian, just quickly again, I know you now have that website for that fabulous seminar that the four of you have got coming up on Wednesday, and it's at the Sydney Masonic Hall. From my understanding, tickets are $19 or $29 for a double, and you're talking about
everything to do with property.
Everything.
So strategies in the market and well, maybe.
And where can everyone get more information about it?
So tickets, if you want to find out more details, grab a ticket, propertybuyer.com.au, or you can call 1300 655 615. So it'll be a good night, so I'm really looking forward to it.
Yeah, it's going to be a great night. Rich Harvey, property buyer, Lisa Montgomery from Resi, you, of course, and John Lindemann.
Yeah.
Who's
So,
he?
well, he's an expert on property, but he's got some great ideas and strategies about how the property markets work. And look, information is king, so get all that information for $19 and a lovely night out.
I agree. Tea? Cup of tea?
You'll get that.
Excellent. And Vicky?
Maybe.
Oh, come on, $19. You think you could give us a Vicky when we're there? Well, of course,
Well, now.
you told me too late, so I can't be there, but have a great time. I know it'll be a wonderful evening. And thank you for tuning in, but we're out of time this week. Next week, you can ask your questions to auction expert David Scholes and the property professor Peter Kolizos. My guests this week, Ian Rodriguez from Bishop Collins and Ben Kingsley from Empower Wealth, did their usual stellar job, and you'll see both of them later in the year when they return to answer your questions again. Thanks also to our callers and emailers for your fabulous questions. This week, our question of the week goes to Soretin. You asked about those original renovations. Oh, yes, you asked about those original renovations and whether or not you could claim them. If you would like to email me right now on your money, your call at destiny.com.au, you can see that on your screen in a moment, your money, your call at destiny.com.au. I'll send you a copy of my brand new book, How to Achieve Property Success. Now, if you missed out on the book, you can get the new book from my online store at destiny.com.au and also from any bookstore. It's a great book and a must-have for every budding or experienced property investor. Don't forget to follow me on Twitter, Margaret Lomas AU, and also on Instagram, Margaret Lomas Property. Go to my website, destiny.com.au, to sign up for my free monthly newsletter. Have a great week with your property investing, and I'll see you again next week.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.